Square was born in St. Louis, Missouri, of all places, founded by Jack Dorsey. There were some other people involved, but he was the principal. St. Louis, Missouri in 2009. And during that time, as the history goes, they were coming in to introduce a simple financial product. It was the Square Reader. Remember the little reader that folks could plug into their phone? Like a limo driver or independent business people, consultants, swipe a credit card and trade money for a transaction with you and me. Maybe you're buying baseball cards from them. Maybe they're a simple entrepreneur. Maybe they're at the county fair selling t-shirts. It allowed the point of sale to be in the palm of their hand anywhere and everywhere. So they started there. Where'd they get their money? Well, it was traditional venture capital. They had a Series A, about $10 million in November of 2009 from Khosla Ventures, a premier, very environmentally focused venture capital firm, but also with a lot of finance and security investments. Then a $27 million Series B, remember A, B, C, that's the order of which you raise venture capital. That came from Sequoia, January of 11. So far everything's going along pretty typically. And then suddenly they pop a $100 million Series C in July of 11, led by Kleiner Perkins. Now you got Kleiner, Sequoia, Khosla, and Jack Dorsey. We all knew this was going to be something. It was going to be something big because these are the biggest of the VCs and are now putting 9 digits in play. They move forward, and in 2012, a Series D of $200 million from a cast of investors. So now you really see the company. The company is off and running, and it's moving, and you've got the Cash App has been introduced, and you also have the Square Reader. So now they're looking at, well, basically you're just a credit card processor, and you're taking a percentage. That was kind of what PayPal did. They allowed you to buy things on the internet, and they took a percent. Well, there was more to it, and as you'll see, Jack Dorsey was investing and acquiring companies. As a matter of fact, over the course of Square, from 2009 to date, they have actually acquired 19 different companies, culminating in the 2020. I think it was $50 million, wasn't it, Paul? They paid for Credit Karma?
50 million.
50 million, that's right. So now you've got Credit Karma acquired with Square. You're opening up a palette of small business and consumer. And when I say consumer, consumers like you and me that operate small businesses. So you have SMBs, like formal businesses with a storefront and things like that, offering retail services, the familiar Square point of sale, and also the ability to spin it around, you add a tip, sign your name with your finger. I mean, really slick system. But in addition, you still have mobility. As I said, limo drivers, people that have remote businesses. Matter of fact, over the weekend, the Biz Doc babe and I went and saw some wonderful Stevie Ray Vaughan cover band here in Texas. And they were selling t-shirts for their band, and the woman there that represented the band, she had a Square Reader and she had a Square signature tab. So it was really, really kind of cool to still see that going on, knowing I was going to do the case study now. The point is, that's where it started, but with these acquisitions, a lot more happened. So here you go. They start Cash App in 2013. That was a big deal. That's where people like you and me could trade cash with one another, not just have to do almost like a credit card retail transaction. I could lend you $100. Then they announced Square Capital in 2014, and then an interesting thing happened between 13 and 14. See these here? This is the revenue numbers. Now I'm going to take a pause right now and run through the revenue numbers real quick, but they crossed $500 million in revenue. So that means they're suddenly doing $40 million a month, which is over $1 million a day. So suddenly this is a very, very real company. And if anybody doubted its ability to get trajectory and altitude in financial services industry, where everything is spelled with a billion, not million, financial services, it's all about the billions, not the millions. So all of a sudden, they're at 850, and they actually crossed the magic billion mark halfway between 14 and 15, and then toward the end of 15, no surprise, November of 2015, they have their IPO. Now, what's interesting, if you step back here, there's a little bit of controversy around the IPO that I'll talk about. So when you're raising venture capital, they put a valuation on your company that you mutually agree. Sometimes you can look at comps or comparatives of other companies that are out there. Sometimes you can't, and it's what the venture capitalists and you wrestle to determine the valuation of your company. Well, when they did that $200 million Series D, they had a valuation of $3 billion. So they are in the unicorn club 3 times, $3 billion. They then raised about $100 million in debt in early 14, I think it was. And then in October of 14, they raised $150 million in a Series Z. Now, there's an interesting thing here. Why would you raise $100 million in debt? Well, it all has to do with dilution, because that was a $6 billion valuation when they raised the last $150 million in the Series Z, which would be the last of the venture-funded phase for Square. Now, why should you wait and raise that? I think there's a small lesson here. Whenever you can extend the time from one financing round to the other, and your business is on a good trajectory, you are decreasing the percent of the business you're going to give up in the next round, meaning your business will be more valuable. And if you, let's say your business is worth $300 million, pick a big number, and somebody invests $100 million into it, the 300 plus a 100 is 400 million. So therefore, that 100 is 25%. So that investor or the group of investors would have 25% of it. Now you can roll this all the way down to make it 3 million. You took 1 million and they had 25%. The same principles apply. But the longer you can wait when you're developing your product and developing traction and developing customers and developing revenue, the better it is, so that you give up a less percent next time, and still people want to invest, especially if you're taking off. Thanks for watching the short clip. If you like that and would like to see the whole episode, you can find it right here. And for even more, subscribe to this channel right here.